Indus Holdings. Hey, George.
Hey, what's going on, Matt? Thanks for
it's good to
thanks
see
a
you
lot for
again. I
having
haven't
us.
seen you in a while, so it's good to catch up. And we'll do it sort of open forum. So there's a couple slides I think you have here that are very informative, and we can hit those. But why not just for individuals that don't know the name or might be newer to the space, give a quick overview of Indus, and then we can jump into some more pertinent questions in the business strategy.
Great. So, Matt, as I said, thanks for having us, and appreciate the support and allowing us to tell our story today. So, Indus, publicly traded company, it has been focused since it went public in 2019 on California. I got involved in Indus in April of this year when I led a restructuring of the business. At the time, the company was really struggling with financial health, limited resources in terms of cash, as well as a business model that was struggling to get to positive margins. We led a $16 million recap of the business, which at the time felt like a heroic amount of capital to raise for a cannabis company, and we've been pursuing a sort of strategy around a new mission. Basically, we're focused on California. We had a transaction, a legacy transaction, to move into Nevada. We paused that or pulled out of that transaction. We're focused on unlocking the core profitability from our operations, and you'll see that there's a tremendous amount of profit potential from the business that we own and operate today. And then we think beyond the business that we own today, there's a huge amount of supply side capacity that's ripe for consolidation within the California market. California, I think, is somewhat misunderstood in terms of a market that folks confuse as being vastly in an overcapacity mode. We think the market there is really populated by a very long tail of mom and pop operators, and we have a substantial scale advantage. So at all points in the cycle, we think we can drive real margin in the business, and we're going to try to take that bigger. Today we're at 225,000 square feet in our greenhouse, and our goal is to get to over 1 million within the next 12 months. And we think that, beyond that, you've seen a huge shift in California in terms of the market the model that's working well in California, and where we think there's the potential is using price to win consumers over. I think the jury is in California as to what consumers respond to, and value is by far the number one thing that consumers respond to. We have, by being vertically integrated, our own feedstock, our own manufacturing, and our own distribution network. We think we're unique in that, and I've got a slide on that a little bit later, but we think that's unique to us, and that allows us to basically collapse the value chain and bring more products at a better value to consumers and win shelf space. So that's the plan.
Great. The California market, obviously most mature, if you include obviously the illicit market, most mature in the world. In the legal market, we're a couple years into this, and it can be very fragmented. So I think you have the controls, George. Just maybe let's flip to slide 13. I'm looking at your corporate deck. I think would be a good guide for the next couple questions I have, where it shows the value chain. Yeah, so this is something. A lot of questions I get from investors. Even going back a couple of years ago, is, okay, well, how do I get exposure to what is probably down the road, a $10 billion market? And you have, looks like there are 660 some odd licensed dispensaries. There's probably a couple thousand more that aren't. And just maybe we'll start on that end of the value chain. What are you seeing with respect to illicit market sales transitioning into retail sales or legal retail sales? Is the value segment, is pricing a big part of it? Is there a perceived quality difference between what legal operators are doing and those that are in the illicit market? It's a very, like I said, mature market when it comes to cannabis awareness. So how does that 661 licensed stores today, compared to where we've been, a year ago, and what's the trend like with respect to this market transitioning to actual legal?
Yeah, I think, and I think, Matt, what's really implicit in your question is sort of, where does California stand today with the legal versus illegal market? And I think this is something that I think we should spend a couple minutes on, because it's a common misconception, and somewhat I think it gets lumped in a little bit with the Canadian markets, whereas folks tend to think of California and Canada as relatively similar. They both have unlimited licenses to a certain respect, and there's certainly a challenge with the legal market taking over from the illegal market. There are some pretty important differences, though, in terms of California. California absolutely does still suffer from an illicit market challenge, but it's less at the retail level than you might think. And this is a really important distinction, and one that makes our business particularly powerful right now. So what's happened in California is the consumer themselves, they've been spoiled. They have among the best selection of legal cannabis in the country to choose from, and they have extremely good prices and value to shop with. The illegal market still grows a tremendous amount of cannabis in California, but from what we can tell, an increasing percentage of that illegal cannabis is actually going out of state. And the reason for that is extremely obvious, right? If you really think about it, if I can sell illegal flower on the streets of Los Angeles and compete with legal dispensaries, of which there's one every other block, if I can sell it there for $35, $40 an eighth, but in New York City I can get $70, $80 an eighth, I'm not going to be inhibited by the federal rules that keep me from moving products across state line. That product's headed to New York. And that's largely where the illegal market is today in California. We do see still some illegal delivery services and some illegal dispensaries that absolutely still exist. But for the most part, the connection between the California consumer and the cannabis industry is actually occurring at the legal dispensary. Now, the challenge with the market is that the supply side of cannabis and this isn't at our level, but at the lower levels, and you have a very, very long tail of suppliers in California cannabis. The legal operators, those that have raised their hand and registered licenses, there's close to 3,000 legal operations in the state, and the average cultivation footprint is 14,000 square feet. Now, within that long tail of operators, you have folks that will move products to the illegal market because they can realize a higher price there. This has put a tremendous amount of pressure on a whole swath of operators who were just in this manufacturing and processing landscape. There was a big assumption several years ago when businesses got funded in California, the premise being, I can invest in branding and marketing and I don't have to own my own cultivation because there's so much cultivation to go choose from. I'm just going to buy it on an as-needed basis. That model has backfired in California largely because prices have risen on flower. And anybody who's in that sort of, I don't produce my own goods, but I package my own goods and I try to sell them as a branded product, anybody who's in that category is getting extremely, extremely pinched right now inside California. We're using this moment where we do source our own product. We have our own branded goods sourced from our own feedstock. We're using this moment to drop prices on those competitors to places where they simply can't get to because there's no way for them to source their own product at those prices. And that's an opportunity for us to take share. And we see very few competitors as well positioned to do this. We are one of the few operators in California that spans across this footprint of cultivation, our own manufacturing processing, as well as distribution. We think we're the only operator at scale doing this. And that allows us to bring prices to retail dispensaries that are, frankly, that blow the competition away. And that's our game plan.
So, maybe staying on a similar slide, but just showing, where Indus goalposts are. Is there a better, you have them all three, but is there a more profitable or better area to be in this market? Because at first, we saw some companies just try and get into California via distribution. And we know distribution alone, the margins can be very thin. It says, many brands try and even do it themselves. So, maybe piecing it all together, obviously you're going to get more efficiency and more margin doing all three, but maybe just give a quick comment on what the actual climate is right now in these pillars. You talked about cultivation already and retail. So maybe on the process manufacturing, I guess put branding in there. And then on the distribution side, what's the competitive landscape in those two pillars right now?
All right, so this is a really important distinction and one that we'll talk about in our numbers in a moment. When we talk about distribution, there's really two avenues for distribution to think about. There's Indus historically spent a lot of time and a lot of effort going down the route of being a third-party distributor, meaning that I'm going to build the rails and I'm going to rent them out to anybody that comes along and wants to use our distribution network to access our network of dispensaries. I view that business very skeptically when I got into this investment, largely because what you're effectively doing is taking network and infrastructure that we've built, distribution hubs and software and technology and investments we've made into trucks and drivers and driving routes, and you're renting that out to people who can't afford to make that investment. You're effectively arming the competition on branded products because you can make a quick buck in doing it. My view on this business is we are pulling back from that in a pretty material way. You'll see it. It's really declining. The distribution only business and our revenue stream is really declining, and that is fully by intent. We are out of the business 100% of arming our competitors. Now, in terms of doing our own distribution, it's extremely important. Distribution is a really, really fundamental touch point that we have with our retail dispensaries. It's not only about dropping products off, but it's about our driver walking into the dispensary and collecting on accounts receivable. It's also about our driver walking into the dispensary and having a dialogue with that dispensary about what our impending product pipeline looks like, and having a conversation about what's moving inside that dispensary and using that feedback loop to encourage sales to reach out with a new product portfolio. So distribution is really fundamental, but third-party distribution, it's a bloodbath. I don't like the business from an economic standpoint. It was very low margins that we were in it, and it enables too much competition from my view. So to the extent that there are still some anomalies where we're in the business because of long-term contracts or relationships we view as pretty fundamental, but in absence of those, we're going to move away from distribution. Now, process and manufacturing, it's an important part of the value chain here. As you know, over 50% of the goods by dollar value in dispensaries are manufactured products. And we view our capability of being able to produce everything from beverages to tinctures to gummies to mints, all the way up to concentrates, dabbable concentrates. We view that as a really important fundamental advantage for us. We use our own feedstock, we create our own products, and we put it on our own trucks. Now, what matters to the consumer is price. And we've done a tremendous amount of analytics around this, of where is the consumer willing to overpay, or where is the consumer willing to pay a little bit more for brands. And the full reality in California is this consumer responds to value. And nobody can deliver the value, I believe, without owning this amount of real estate across the infrastructure, because the value is going to move depending on supply and demand within each one of these segments, each one of these three pillars. But if you don't own all three, you have a real risk at any given moment of getting pinched.
Very, very helpful. And then any sort of estimate on, if a product, just for easy numbers, sells for $100 at retail, typically the wholesalers get half of that. So are you seeing kind of half the economics by owning those three pillars of what, the retail value is, or is it a different rule of thumb in California?
Yeah, so the rule of thumb is slightly different. I would say the markup is more than 2x in California. It's a little bit higher. It's starting to come down a little bit. It depends on categories. Categories that move very quickly in California can be below 2x. Categories that will tend to sit on shelves for longer and have longer shelf life, or more competitive categories, you'll see something closer to 2.5 times multiplier. So, But yes, the rest of that economics, that's ours. That is 100% our business. We capture all of that value, and we don't pay third-party services for anything that we do other than sort of testing.
And what's the landscape now? I know when I was going around the California market a couple of years ago, in its first year of legalization, there seemed to be a lot of business just trying to do toll manufacturing, buying one piece of equipment, having a very small square footage of licensed, licensed square footage, making just a couple of runs of vape pens a week or whatever. Are those players, whether it's from capital shortage or whatnot, are those players starting to dissipate, or what's the climate now in California for just making products if you don't own the other parts of the stream?
Well, there's a lot of big players. There's a lot of big players who bet sort of the ranch on that strategy. And we obviously know our competitors, and we know that they're trying to move into cultivation. Whether or not they can move into distribution, I think is a harder one for them to get into. But I think the reality is what you're seeing is anybody who went into that, I see a huge amount of value and arbitrage between buying, dried trim from outdoor growers at $75 to $200 a pound and boiling that down into distillate and making my own vape pens that I can sell into dispensaries using a third-party distributor. That business is a bloodbath. And if you get pitched that business as an investor, walk away immediately. It's a complete Potemkin village of value. The only way that you can have any sway over what sits on shelves in an incredibly competitive market is to have a full array of products. And you have some products in there that are very hot, like our dabbable concentrates are an extremely hot product in California. And that drives as a wedge us putting other products that are more commoditized onto shelves. If you look at the gummy category, the price banding on gummies in California is very, very narrow, right? But who are you going to put in and put on the shelf as a gummy when consumers tend not to really differentiate between them? It's a tin, it's 100 milligrams. I know I'm going to get high, and I pretty much know how high I'm going to get. The reality is that consumer only responds to price, but he's also going to respond to what's on the shelf. And if you're using your highly sought after flower brand or highly sought after dabbable concentrates brand as a selling incentive to put other products into those dispensaries, you've got a much better chance of survival. The idea of walking in with an extraction machine, boiling down concentrate, I think we all saw that business model. We knew it was going to disappear, and it disappeared real quick.
Right. Well, that's very insightful. So I guess looking ahead in sort of your business model, is there a focus on any particular type of product SKU that you think makes sense, or is it more the gamut? And maybe going to, I think it's slide 19. I just lost it on my screen here, but you actually have your core brands. Maybe I jumped ahead too quickly. Why don't you start on slide 19 and just give us an overview of what the actual manufacturing capabilities are from an actual SKU standpoint, and then where you think the value proposition is for some of these. So that's that's like the one I'm looking at, slide 19, which actually has the brands on it. But however you want to take it is fine.
Well, I may have a different slide.
Oh, I'm sorry. I'm just on your website.
So,
okay, it might be different.
Oh, okay. Let me stick with this one if it's okay.
Yeah.
I would say, I think the surprise of a lot of people in California, if you look at the standard deviation of pricing in California, so like where a consumer is willing to pay more for the same sort of like product, there are categories that are very narrow in California. And the only way that we're going to win shelf space in those categories is what I said before, which is you're going to hit hard, and you're going to hit it hard on pricing, and you're going to undercut the competition in order to put them out of business. There's no other way to do it. There are other categories, and it's really interesting to think why those categories do this, but there are other categories where you see a larger standard deviation of pricing. And what that means is the consumer walks into a dispensary and he's not looking for 100 milligrams of gummy to take to a party. but he's looking for something that he has attached more value to, or she's attached more value to, because the brand means something. And flower is the category that is the largest example of this in California. You see a huge discrepancy in pricing in California in terms of where flower is. Now, we believe that the consumer, and I'll take you to a slide here if it's okay, I'll take you to a slide that I think is really interesting. When you look at how the consumer responds to price in California, what they're really buying in California is potency. They want potency. The higher the potency, the more they're willing to pay for it. Now, the good news for Indus, when I got into this investment, when we looked at the pricing that was prevalent in the market at different potency levels, which is the blue line in the back that we collected from thousands of different of data points in the state, that is basically the correlation of the average price and the average potency in California. Now, our product was substantially underpriced relative to that. Our product was priced as a flat bar, meaning that we didn't increase our price for higher potency, and our product was priced at a substantial discount to where it should have been priced. Now, I think there's an opportunity here to raise the gray bar, which we have done, to put a slope on the gray bar by increasing prices on higher potency products, as well as keeping the gray bar still below the blue line as a mechanism to take share. And that's what we've done so far, and that's really the business plan. You know, other categories where we see huge potential, obviously we know vape pens are a big category in California. You know, live resin has commoditized just as quickly as the regular vape pen market. We've seen that product with a very, very minimal pricing headroom, or this standard deviation that we talk about. Gummies are another category where you have to come in low on price to move products. Concentrates are an area where, again, the real reason why flower and concentrates have higher pricing headroom is there tend to be products where consumers share the product, right? If you think about, like, use the socks versus shoes analogy. People don't overpay for socks. People aren't willing to buy designer socks because you don't share your choice in socks with the world, but you do share your choice in shoes or sneakers with the rest of the world. It's a pretty obvious or sort of displayed set of your values. And so that's where we think of where you see products that have tighter pricing headroom, and you need, the only way to win the consumer over is on value, are products where the primary value proposition is based on concealment. So that's gummies, pressed mints, vape pens, right? Those products were really based around, I'm going to hide the fact that I'm using cannabis today, relative to flower and dabbable concentrates, which are much more used by people who are open about their choice of cannabis and willing to share that choice with their friends. And so our view on this business is we're going to make headway in both. We have a value differentiator that allows us to drop price on the more commoditized categories, and we have some of the best team in the country on making flower as well as concentrates to win over the consumers at the high end.
That's an interesting insight. I haven't heard that before, particularly on the flower side. I think that makes a lot of sense. I have to jump to do the next intro, but just in the last minute or two here, and apologize, I'll have to scoot off, but maybe if you could just share, what you think, investors should look at as key performance indicators in the next couple of quarters here, more near term, whether it's, revenue acceleration, operational adjustments, more exposure into stores, things that are more tangible that investors can look to in the next 6 months here. Apologies, I'm going to miss the answer, but it's great speaking to you, George, and we'll chat again soon, I hope.
Hey, Matt, thanks so much. I appreciate it. So I'll answer the question from Matt, and we'll go through this real quick. I actually don't think our investors have to wait all that long for a proof point of what our turnaround looks like. We guided last quarter to revenues of $13 million. This quarter, that's driven by a an over 50% increase in our own products, and a decrease in sort of the lower margin products out there. So we've taken a business, or the guidance is to take a business in the space of 2 quarters from negative gross margins to positive EBITDA margins, and that's our expectation for the quarter ended September 30th. So I think in a lot of respects, I think we've proven that we know how to harness value out of these assets. We have a number of product launches over the next quarter or so that are really going to test out our ability to use price as a primary vehicle to win shelf space at dispensaries. And I look forward to updating our investors to our success there.